Good afternoon, ladies and gentlemen, and welcome to the investment webinar where we will be focusing on the post-COVID economic environment and the role of the South African banks. I'm Donald Rogan and I'm responsible for the investment management business at Nedbank Private Wealth, and I will be your host today. I'm delighted to be joined by two very important people, Mike Brown, the current CEO of Nedbank and ex-chair of BASA, and Nikki Weimer, who is the group economist, group chief economist. Just a little bit of housekeeping before we get started. The session is intended to run for 1 hour and it will be recorded. In a few minutes, I'll be handing over to Mike, who will then hand over to Nikki Weimer to do her presentation on the post-economic COVID environment. During Nikki's presentation, you will be able to submit questions via the chat functionality on the right-hand side. So Mike, over to you, and I presume the last 6 months have probably been some of the busiest months that you've experienced in your long tenure in the financial industry in South Africa. We'd be very interested in your reflection, Mike, of the last 6 months and the role that the South African banks, along with the regulators, have played. Thank you.
Great, thanks Don, and good afternoon everybody. It's good to see, I think we've got more than 400 people joining us on the call this afternoon. So for the next 10 minutes or so, Don, I'll share some thoughts on the banking system in South Africa and the role of banks in the current environment. And certainly it has been an incredibly busy last 6 months. So if I start with the system in total, in almost every single report you read about the South African economy, and there have been lots of them lately, from the IMF, the World Bank, World Economic Forum, rating agencies and others, our financial system, and obviously the banking system is an incredibly big part of that, the regulation of it, and as well as our deep and liquid capital markets, is always highlighted as one of the significant strengths in our country's economy. There are also criticisms. Most of them point to a lack of competition, and that I can assure you as the chief executive of a bank is certainly not how we experience the market on the ground, with very, very strong domestic competitors. We've seen the growth and emergence of Capitec in the retail space over the last 15 years or so, and they're now moving into the SME environment. And we've also had numerous international competitors in our markets, particularly on the wholesale side, and more recently a number of new entrants in fintechs, catalyzed by the convergence of technology and changing client behaviors. Financial regulation in South Africa has always been incredibly strong, and I think Errol Kruger, who we can thank for that, is on the line listening in today. But just to give you some sense of the life of a big bank in South Africa, in the last 5 months to the end of May, Nedbank would have tracked 224 regulatory engagements of some sort. That doesn't include telephone calls, etc. So that's more than a day if you count weekends. Our market is seen internationally as an early adopter of global best practice in the form of the Basel frameworks and international financial reporting standards, and we only have very minor amendments to those to align with domestic circumstances where necessary. At industry level, the Banking Association, who Don told you I've had the honor of chairing for the last 2 years. I handed over last week to Richard Wainwright, who's the chair for the next 2 years. But the Banking Association, the SARB and National Treasury are in very regular contact to discuss the safety and soundness of the system and to workshop suggestions as to how we can maintain or improve this. And very early on in this crisis, so here we're thinking about from March onwards, we were meeting weekly, and more recently we've now shifted that to only meeting every second week. And the product of these ongoing engagements were reflected in the numerous regulatory interventions that have been designed to enable banks to provide additional support to their customers and as a result the economy, but importantly at the same time not impact the safety and soundness of the overall banking system. So these have been reflected in things like the reduction in the minimum liquidity coverage ratio from 100% to 80%. And importantly, that's not because of a shortage of rand liquidity. I'll talk about that a little bit later. But it's because in a time of crisis, naturally, many depositors would keep their money more in overnight or call in case of need. So, for example, if someone previously had a 6-month deposit, when that deposit matures, highly likely that in this environment, people are going to say, I'm not going to put it out for another 6 months. I'll put it into the short end of the yield curve in case I need it operationally, even if I do get some interest uplift further down the yield curve. Now, given the rules of Basel generally, shorter dated deposits, banks have to invest almost all of them in something called high quality liquid assets, which is basically government and other paper, and not in lending or into the real economy. So that's why this LCR ratio was adjusted. In addition, capital buffers were reduced on the logic that capital buffers have been built up in good times and buffers should be used in more difficult times, along with guidelines on capital preservation in respect of restrictions on dividends and certain cash incentives. And all of these, I believe, were introduced remarkably quickly by our regulators and the industry. And that is indicative of the very good working relationship that we have to ensure that the system works well. So because of its vital importance, I'm going to start by focusing on liquidity in the system. And it's often said that if capital is the blood in the banking system, liquidity is the air in the system. And without it, you're in trouble pretty quickly. So I think very importantly for the stability of the SA banking system, as a result of the operation of exchange control, the rand liquidity pool is stable inside our country. So what that means is that at a practical level, every day the treasurers of the clearing banks and the SARB effectively balance the rand funding pool 100% across the banking system in South Africa, meaning that the SARB controls a money market shortage as their means of transmitting interest rate policy into the market, and they control that through the operation of the interbank and repo system. So this means that on a total basis, rands can't unexpectedly leave the system. And practically, we've seen this play out, those of us who've been in the industry for a long time. In many of these crises we've seen, the small bank crisis in, 2001 and 2, and the global financial crisis, and then again in the ABLE crisis more recently, where in effect all that happened was the depositors who withdrew their money from ABLE placed that money back on deposit with the other larger banks, who in turn placed that same money back on deposit either with each other or with the Reserve Bank, and the Reserve Bank then used exactly that same money to keep ABLE's liquidity pool whole in that environment. That is a very, very different banking environment to a bank in, say, Paris or Turkey, who, when the treasurer might lose some euro deposits one day, they could pop up anywhere in the Eurozone, making it very difficult for the central bank to play the role of liquidity provider, and it's much more complex. And in turn, it makes the liquidity in South Africa much more stable than in many other markets. So in short, to go back to my previous analogy of liquidity being air, in South Africa, the air can't leave a room. We compete for that air every single day. But in many other markets, the windows, doors, and maybe even the roof are open. So you really don't know where that liquidity is moving to when the wind blows against you. Now, South African banks don't get unsecured money from the SARB. Contrary to popular belief in some circles in our country, there is no free lunch. So banks are required by regulation to hold a minimum amount of what is called HQLA, or these high quality liquid assets. And these cost banks in margin because we earn less on them than our cost of funds, but we pledge these high quality liquid assets to the SARB to enable us to access the repo facility. And just to give you a sense of the size of this, for Nedbank, with a balance sheet of just over R1 trillion, we hold currently about 200 billion rand in high quality liquid assets on our balance sheet, enabling us to access cash if we ever need it. And that is, on the positive side, very, very good for liquidity. but on the negative side, it is one of the reasons why bank ratings are, particularly under Basel III, so closely linked to sovereign ratings, given this regulatory requirement for you to have, circa 20% of your balance sheet invested in government assets or high quality liquid assets. Early on in this crisis, the SARB made a number of changes to the repo system, really to signal and make it clear that against the pledge of HQLA, they would inject liquidity into the system in times of stress, as is their role. And if we look back now in hindsight to the almost unprecedented market volatility that we saw in March and April, liquidity management in the SA banking system operated very well and has reverted now to normal levels of activity. And that's evidenced by the fact that the SARB has now reversed many of the changes that it made to the repo system in March. But certainly no one is complacent. The bank treasurers and the SARB meet regularly on this, and I'm sure that the SARB stands ready to reintroduce any measures that are required should it turn out that we are currently only in the eye of the storm. Moving from the air in the system being liquidity to the blood in the system, which is capital. The South African banks certainly entered what is increasingly being referred to as the Great Lockdown Crisis, or GLC, in a materially stronger capital position than the GFC, or Global Financial Crisis. So if you take Nedbank as an example, our common equity tier 1 ratio, or at that stage it was called core equity tier 1, was around 8% going into the global financial crisis. And that was enough to manage very well through the global financial crisis without any capital challenges or shortfalls. And we entered the GLC with a CET1 ratio of over 11%, so around about 40% higher capital levels than the global financial crisis. So that obviously begs the question, how will the GLC or lockdown crisis compare to the GFC or financial crisis for South African banks? And with the caveat, as a Nobel laureate said, that forecasting is difficult, especially when it is about the future, and especially so in the current environment where case numbers are still escalating in South Africa and second waves around the world could emerge with greater levels of economic lockdowns. But I think the following that I'm going to go through are very relevant inputs into any forecast of the GLC versus the GFC for banks in South Africa. So let's start with what's likely to be worse than the global financial crisis. Certainly, we know that the South African economy went into the global financial crisis in significantly better shape than the global lockdown crisis, with much lower debt to GDP ratios and therefore more sovereign firepower and indeed more delivery capability at that stage. It is very sobering to recall that our debt to GDP ratio was around 28% at the start of the global financial crisis versus likely over 80% at the end of this fiscal year. The GDP contraction is also going to be a lot worse, with most estimates for GDP in 2020 for South Africa ranging from -7 to -10%. I'm sure you'll hear from Nikki later, and taking 3 to 4 years to recover back to 2019 levels. Over 1 million jobs are likely to be lost, with unemployment up from around 23% in the global financial crisis, with estimates now peaking at around 35%. I think with that as background, never before has a medium-term budget statement been more important, as effectively in the supplementary budget, many of the hard decisions on structural reform were kicked further down the road into the medium-term budget statement. And certainly as the Banking Association and also in my role as Vice Chairman of Business Leadership South Africa, we've been very engaged through Business for South Africa on the paper that was released last Friday from Business on a roadmap for delivering an accelerated economic recovery strategy for South Africa. And we really hope that that document is part of the discourse leading up to the medium-term budget statement. So in addition to that, from an economic point of view, from an accounting point of view, IFRS 9 which is the accounting statement for bad debts, they're now called expected credit losses, is new since the global financial crisis. And it does lots of things, but one of them is that it will result in earlier accounting recognition of impairments than in the global financial crisis. However, I think it's important to remember that accounting can't change actual bad debt results. If you lend somebody 100 Rand and they pay you back 98 Rand, your bad debt will be 2 Rand. But the various accounting standards determine how quickly or slowly you recognize that 2 Rand over the period of the loan. And IFRS 9 would mean on a ceteris paribus basis that it would be recognized earlier than under the previous statements. I think also compared to the global financial crisis, at the epicenter of that was the financial system and overextension and risky lending practices, primarily in the US. I think the global lockdown crisis has a much broader economic impact across multiple sectors, given the impacts of the lockdowns on various economies. So on the other hand, what's likely to be better than the global financial crisis? Firstly, as I said earlier, in the global financial crisis, banks were at the epicenter causing the problem. Fortunately, this time we are not to blame, and working alongside regulators are seen as a key part of the solution in enabling economies to recover. Loan growth going into the global lockdown crisis was significantly lower and more prudent, low single digits, versus the double-digit growth going into the global financial crisis, meaning that for Nedbank, and I'm sure this is true for the industry, by the end of 2018, loan books were probably in the best quality that they had been in for the last 10 to 15 years, with some deterioration appearing during the course of 2019. In addition, globally, stimulus has been bigger and faster than in the global financial crisis, in many ways driving up asset prices as interest rates have been cut aggressively, and it remains to be seen how sustainable this is. Domestically, on the stimulus front, 500 billion of stimulus has been announced, including the 200 billion National Treasury SARB loan guarantee scheme, of which only 100 billion Rand has officially been activated by SARB and National Treasury in mid-May, a scheme wherein banks share in 6% of the losses and the National Treasury and SARB 94% of any losses. Now, the Banking Association publishes data on this on a 2-weekly basis. And at the end of June, around 11 billion of that 100 billion that has been activated had been dispersed, and several billion more were still in the various banks' approval pipelines. So while there's been criticism of the slow take-up, all over the world, these types of schemes have required amendment from time to time, and the SARB, National Treasury and banks are actually right now in the process of finalizing the agreements to those amendments that we think will increase the take-up. But at the same time, we do need to balance that there is not undue risk on the banking system or indeed the fiscus and ultimately taxpayers as a consequence of that. In total, around 33,000 applications have been received for the scheme as it currently is. And if you allow me to make a big assumption, and that is that on average, all of those applications would be the same average loan size as those that have been approved, that would mean that total applications currently would be for around 48 billion Rand. I think in addition, it's extremely important to note that in South Africa, the banks themselves, prior to the introduction of the loan guarantee scheme, had proactively entered into restructuring arrangements with clients in good standing, as enabled by the Reserve Bank's Regulation D3. And again, at the end of June, the Banking Association publishes industry data, and these amounted to some 40 billion Rand of installments, most of which were already in place prior to the loan guarantee scheme. For Nedbank, we highlighted in May that at that stage, we had proactively worked with our clients in good standing to restructure over 350,000 accounts, amounting to just over 13% of our total loan book, all while operating at around about 30% staff physically present on our campus sites, and only about 60% of our branches physically open, with the remainder being used for backup sites or alternate call center sites. And, I think that really is an incredible achievement, testament to a combination of the benefits of digitization and of the extremely hard work of our people under enormously difficult circumstances. So just in conclusion from me, we know that we are in the midst of a health, economic, and emerging social crisis. And our economy in South Africa this year is likely to contract the most since World War II, with Q2 GDP likely to be the peak decline at well over 30%, and full year GDP somewhere between 7 to 10% down, as I said earlier. So while we are well prepared and I've described our banking system as strong, this is clearly a very difficult environment for our clients, and as a result for bank profitability in general and bad debts in particular. And across the system now, all listed banks have, through trading updates, signaled that 2020 earnings are likely to be materially lower than last year. And during the month of August, most of the banks will report their H1 numbers for this year. And I think it is still uncertain as to how long it will take for the recovery in earnings to get back to 2019 levels. For us, this is a time where our primary focus at Nedbank is on the health and safety of our staff, and wherever possible, helping our clients in good standing to manage through these challenging times, with a much bigger focus on resilience and stability of the system and less focus on short-term profitability, other than as a buffer against capital. I'm confident that the industry will play its part in managing us through this unprecedented crisis, using the buffers that we've built up and the inherent strengths that we have in our system to help our clients and the economy, and as a result, minimize the impact of this unprecedented crisis on our country. So thank you. I hope you found that useful, and I will now hand you over to Nikki.
Good afternoon, everybody. I hope you are all healthy, and I hope you are all excited and ready to brace yourself for a little bit further bad news and maybe a little bit of green shoots along the way as we go through the presentation. So essentially, my brief today was that I meant to really tackle the topic of what a post-COVID economy would look like. Now, that's actually quite a big ask if you think about it, partly because, as many of you, I am sure, will very keenly attest to, economists are no better at predicting the future than any other professions. So there's that. And then also because, as Mike has quite rightly pointed out, the crisis is to some extent still unfolding. Well, very much still unfolding. So given that we have these many moving parts and there's all of this uncertainty still in the very short term and maybe even over the medium term, I thought it would probably be better to share with you really what we do know about the impact of this crisis on the economy and on the markets. So to highlight those things that we are fairly certain about, and then also to share with you the scripts that we have seen across our desks on what a post-COVID South Africa could potentially look like. And once we have done that, I think I will conclude by really just not expressing an explicit preference for one type of South Africa over another type of South Africa, but rather just to point out those key elements that absolutely need to be addressed in each of these scripts to ensure that we have a blockbuster at the end of the day. So those are the ones we will end with. Those are the bits that we will conclude with. And then we will obviously go to your questions and see if we can add some value in the process. So before I dig into this theme of the post-COVID South Africa, let's just bear in mind that we are still very much in a situation where the crisis is unfolding, the pandemic is still raging. Globally, it has not yet been contained, nor has it been defeated. There is hope in that progress is being made every single day. We are learning more and more about this virus. Scientists are gathering information. There have been some successful developments and discoveries in terms of how to treat the virus effectively. As a result of that, we have in fact seen across the globe, even though new infections continue to climb, that mortality rates are coming down. So the treatment of the virus have become increasingly effective. And at the same time, we are in the process where there has also been globally some developments and promising trials, although very early stages, of vaccines being developed. But the reality is that this is what the new rate of infections look like. It just continues to climb higher and higher. The initial sort of wave was driven first by China, and then the rapid spread of the virus across Europe. And then we sort of had America come into the picture there as the third epicenter. And then there was a bit of a lull. It was a hopeful spell. This is the period in which the markets really pulled back quite strongly. And then we saw another explosion come through, particularly in South America, but also in the United States, as the virus spread from the states that were hit first to to greater parts of the United States. So that is where we find ourselves in the world at the moment. This virus is not over. We are still very much dealing with the problem. In the case of South Africa, how are we faring? Well, infection rates are accelerating very rapidly. This is not unexpected. It is a little bit scary. We now have over 200,000 confirmed cases in South Africa. So there's no denying that it is frightening, but I think we need to bear in mind that it is not unexpected. Government has repeatedly said that this will happen as we ease the lockdown, that South Africa will not be able to avoid this sort of rapid climb up the sort of normal distribution curve, if you like. And government is now saying that it's possible that we could peak sooner, maybe end July, early August, where initial expectations was that South Africa would hit this sort of theoretical peak in infections around September. And although all of this is very frightening, and all of us in our workplace, in the world around us, in our neighborhoods are increasingly more personally involved in this fight, know people who have been affected, we sometimes as South Africans, we get so caught up in the doom and the gloom that we often forget the bigger picture. The bigger picture is that South Africa is actually coping for a middle income developing economy fairly well with this virus. And that is really visible in our mortality rates, which remain well below the global average. Here I have a couple of examples for you. You can see that in the case certainly of France and Italy and Spain, mortality rates that sort of varied around 12 to 14%. You know, since then, it has been coming down, partly because effective treatments have been found. You can see in Sweden, they have managed to bring it down quite substantially. Then there is another group, including the United States and China. They are sort of between that 4 to 6%. And then you can see South Africa, the pink line here, really at the lower end of the spectrum throughout. Even now, as infection rates are climbing very rapidly, mortality rates not only remain constant, but they appear to be drifting slightly down. So that's some encouraging news, something that we can take heart from, that in reality, we are actually not dealing with the problem in any sort of way or mean that compares that much worse, where the comparison is that much worse with the rest of the world. Okay, so given that this is the context, that we are still in this unfolding crisis, let's have a quick look at what we do know. And let's start with the world economy and the global markets. And as far as that's concerned, certainly there has been some sort of a recovery coming through, especially in equity markets. We have seen some stability return across the globe. Risk appetites have normalized. Your volatility indicators have also become more stable. They haven't receded dramatically. There's still a tremendous amount of uncertainty, but they have certainly been more stable. I think a key factor here is that clearly risk appetites are fragile. It's really being driven by the economic news coming in on the one hand, and on the other hand, by news of any kind of second wave or acceleration in transmission rates of COVID-19. What we have seen, though, is that equity markets have had a nice little pullback from the very sharp implosion that occurred in late March. But investors recently, if you look at this graph here, you can see that things are drifting sort of sideways again. There is uncertainty. Investors are sort of now at the moment taking the option of waiting and seeing, or sitting on the sidelines, and they are really waiting for your sort of first quarter, or first half rather, earnings results to see whether that actually in a way sort of validates their view of the likely economic recovery. And at this point, certainly investors are betting that we will have a speedy economic recovery. This is now global investors, and that is really reflected in the movement in the global equity markets. And so far, I have to say that most of your sort of high frequency economic statistics, whether it be your global purchasing manager indices, your industrial production or retail sales figures, whether it be the Eurozone, the UK, the US, or China, they generally tend to confirm this notion that the world economy will have a deep dip and then recover very nicely in the second half of this year, and that 2020-21 will, as a result of that, be a bit more of a solid experience. But nobody's entirely certain. Nobody's entirely convinced of this. And everybody recognizes that no one's been here before. We don't really have any kind of historical experience that we can draw from or learn from in modern times that gives us any indication of how this will transpire. Never before has the world economy been locked down. Never before has the switch been switched off and back on again. So we're not entirely sure how this will play out. And what we are seeing is globally, there's a huge debate raging, actually. There's this growing divergence of views on the shape, the speed, and the nature of this anticipated recovery. Now, some believe the Fed will save the day, the Fed will provide. And as you can see in this graph, central banks have not been asleep. The moment the crisis struck, the Fed moved first, cutting interest rates dramatically back really to the sort of levels that prevailed during the global financial crisis. At the same time, they went back to the printing presses, and they have really rapidly expanded quantitative easing. Not only have they expanded it, but they've broadened it. They are buying a far greater range of assets with newly printed money. We've seen the same in the Eurozone, we've seen the same in England, and we've seen the same in Japan and in China also, although they have not rapidly expanded the central bank's balance sheet. They have certainly stimulated the economy quite aggressively and offered, the central bank has offered selective support to sectors and businesses and corporates. So we are seeing a whole new world unfolding as a result of that, and central banks really entering markets where they've never been before. And many people believe that this will do the trick. Many investors, many economists believe that it is sufficient, and that ultimately this unprecedented monetary stimulus will really boost asset prices. That will lift confidence, it will revive demand, and it will encourage renewed hiring, which is very important, and renewed fixed investment. And so the world economy, just as it did during the global financial crisis, should return to growth around 2021. Now, others are increasingly more doubtful. They fear that central banks are actually fueling asset price bubbles. They are also starving investors of good quality assets, because as they are going in buying, as the US Fed goes to buy corporate debt, they are eating up all the good quality assets and leaving to a large extent the scraps to the investors. So there's concern about how this will play out. And there is another concern in that ultimately, this another wave of monetary and fiscal stimulus that we are seeing on a global scale is adding a lot more debt to the system that will have to be absorbed over the years ahead. So there is concerns. There is this a growing divergence about what will happen. And as a result of that, we are seeing different investment patterns materializing. We are seeing that increasingly investors are sort of betting on whatever they view as industries that will be either benefit from this crisis, or they will be fairly resistant to the adverse impacts of this crisis and the policy response that we have seen globally to this crisis. So not just resistant to the lockdowns, not just defensive stocks, but stocks or investment classes that will stand its ground against really aggressive monetary stimulation, quantitative easing, and possibly even the threat of inflation further down the line, and maybe even a debt bubble that we will have to absorb if really the world economy doesn't follow the global financial crisis's storyline. So increasingly we are seeing this sort of behavior, and as a result, gold has been one of the major beneficiaries. It's been quite an impressive rally, there's no denying that. Quite volatile there when the global investors went from risk on to risk off, but then came pulling back very, very strongly. And so what we've seen is that South African markets have also strengthened. They've also gained a bit of momentum. And as you can see there, in our case, though, it's been a lot more narrowly based. It's really been driven by resources, financials and industrials, where your performance of these kind of companies are very intrinsically linked to the sovereign. We haven't seen such a convincing and compelling comeback. And that, I think, is the reality. Both global investors and local investors are quite are quite realistic about South Africa's prospects. There are no illusions left. They know that South Africa has been on a long-term economic stagnation path prior to COVID-19 striking. They know that our growth prospects are very limited. It's hindered by very complex historical and current structural constraints, and that one of those examples is simply, a lack of reliable and cost-effective electricity. That's almost the obvious one. But the nature of our unemployment, it's another crisis that is difficult to solve. It isn't simple. A big portion of unemployment is in fact structural, and it is tied to our long and complex and often very divisive history. And so as a result, there are no illusions about the challenges South Africa face. And they also know that, unfortunately, apart from monetary policy, which had a fair amount of ammunition and quite a lot of scope to actually go out there, cut interest rates and stimulate the economy, government has actually got very little ammunition left. And so as a result of it, we have seen that industrials and financials, where our fate is so much closer tied to South Africa as a sovereign, haven't recovered at the same sort of pace than resources. So that's the financial environment we find ourselves in. Things have stabilized. Equity markets have pulled back. The dollar's receded a bit. The rand's strengthened a little bit. There's a little bit less volatility. Conditions are a little bit steadier, but there's still huge uncertainty as to where we will go. So within this environment, what do we know about the impact of COVID-19 and specifically the lockdown? And what will its impact be on the real economy? Well, what we do know is that the recession will deepen dramatically. In April, we had level 5 lockdown. That brought most industries to a complete standstill. And as a result, we have already seen in the high frequency monthly data that monthly production and sale figures declined at paces ranging between 35% to 98% in the case of new vehicle sales. So dramatic declines in production and sales throughout April. And that's what I'm really reflecting for you here. There's mining and manufacturing production, and you can see the red area represents level 5 lockdown. Then we go into orange, which was level 4, and now we appear to be in level 3. And you can see that we're assuming that level 3 will last for quite a while, probably until government is certain that the peak of the infections in COVID-19 is behind us. So that's where we are at the moment, and the declines in April have been dramatic. But we also believe that April is probably the trough, and we are quite surprisingly seeing some very encouraging pockets of resilience popping up across the economy. And we saw this in May and June. A good example of that would in fact be new vehicle sales, and particularly used vehicle sales. This is what happened to new vehicle sales. So in April, unsurprisingly, it plunged by 98%. And then in May, in which auto dealerships were only open for 2 weeks in May, it came soaring back to about 38% of pre-COVID levels. And then in June, we saw it return to almost over 70% of pre-COVID levels. And if we look at our sort of installment sales numbers, in other words, the demand coming through for vehicle finance, it looks like, in fact, new vehicle sales and used vehicle sales will probably return and end this year very close to the sort of levels of sales that prevailed prior to the crisis. So there are these sorts of pockets of resilience coming through. So we know Q2, regardless of the rebound in May and in June, will reflect a frightening contraction in GDP. But we also know that in Q3, you will probably see a pretty strong rebound off a very low base. Now, that's going to tell us a lot more about how far we fell than how strong the economy actually is. But we will see a lot of statistical noise in the GDP numbers for the next 2 quarters. So what will it look like? This has been our historical performance. It's not a very pretty story. You can see I show you the economic downturns as defined by the South African Reserve Bank there in grey. And I also show you the average growth rate during each upswing and each downswing. And you can see that we have moved to a much lower growth path, and we've now already had 3 consecutive quarters of contraction. What's probably going to happen in the third quarter is that in the second quarter is that we'll see GDP fall completely out of the scale, declining by somewhere around 30% quarter on quarter, and then bounce back with something between 10 to 25% depending on the forecaster. These are the sort of ranges you see in the forecasting polls out there for Q2, for Q3. So we're going to have this huge swing effect, and it's going to be a tremendous amount of statistical noise. But in all reality, it's just reflecting the economy going from being switched off to being switched on. But how strong is this engine running? That's really the question. And what matters is not Q2 or Q3. It's really what comes after that. Where do we settle? What sort of growth path evolves after Q3? So I think that's the bit that really matters. And everybody agrees that as we look forward over the next 2 to 3 years for South Africa to return, hopefully not to this very poor episode of growth we've had since December 2013, but for us to return to something a little bit more optimistic, a little bit more hopeful. Like we saw between 2004 and 2008, really, it will be a hard slog. And there isn't as much agreement on how to proceed and how to go forward as we would really like. So what sort of scripts do we see out there on this post-COVID South Africa? Increasingly, we are hearing the terms, we must use this crisis as an opportunity to reset the economy. We hear this from President Ramaphosa. We hear this from journalists over TV. We hear this from the various analysts that provide commentary in the newspapers, on the press, on Twitter, in the opinion pages, on all sorts of mediums. We are hearing this term, we must use the opportunity. We must make sure it's a good crisis. We must reset our economy. The question, of course, is to what? And there's very different views on what this would look like. There is National Treasury's motto. These are the ones I've sort of picked up on. There's National Treasury's motto, which for me is one that really is about, let's get back to the basics. Let's just get that right. And essentially, it's suggesting that we do sensible things like lower the cost of doing business in South Africa, eliminate the red tape, support small businesses. Let's design economic policies that actually get those industries off the ground that is likely to really absorb the type of labor force that South Africa has plenty of, which is low-skilled to semi-skilled labor. And so it suggests we push agriculture, agro-processing, we push tourism, which would be very difficult under the current COVID environment. It also suggests that we keep an open mind towards opportunities on the continent, in the region, that we foster stronger regional ties, we remove some of the obstacles to regional trade and investment, and we take Africa forward. National Treasury is also suggesting that, listen, we cannot address this skills deficit we have in South Africa overnight. Not in 5 years, not in a decade. We can make a difference, but we cannot wipe it out. And therefore, we do need to relook our immigration laws. We have to bring in skilled immigrants to make up for what we lack on the skills front. And in the meantime, we should really work very hard on moving and improving our education system and our post-school training and education. And then very importantly, we've got to reform SOEs. We've got to get going. We've got to finalize the electricity plan. We've got to unbundle Eskom. We've got to open the energy markets. We've got to modernize our port and our rail infrastructure. And we've got to pick those low-hanging fruit, whatever it is. Is it licensing of spectrum? Then we've got to get a move on with that. So that's what they are suggesting. And then the other view that's been really represented in the ANC's discussion document they've recently released is, of course, the whole notion that the state saves the day. It's not said in so many words, but really everything is centered around the state driving investment. That you have this reset in this economy, and essentially we should view this crisis as just the beginning of the Great Reset, and that the state will drive development through infrastructure spending that will, of course, absorb a lot of low-skilled and semi-skilled labor, that will boost national income, that will support demand, and in the process, it will result in this virtuous upward cycle where growing demand results in more investment, more job creation, higher income, greater wealth, and more demand and more divestment and more job creation. So that's the whole idea. It's not a new one. It's not particularly original. It can be very effective if it is done properly and if you can finance it. But they also recommend that we accelerate the transformation of the private sector, that we solve our funding problems by drawing on the passive funds that reside in the pension funds, the pension funds of South Africa. And that whatever shortfall there might be, the SARB can prop up. That's sort of the idea there. There's also a very localized focus in that document, that we should develop local supply chains, that we should encourage local beneficiation. So you see a lot of that. And somehow there is the belief that the private sector will be crowded in through this process of state-led development. In essence, like I say, it's not a new idea. It is really nothing other than your Latin American style state-led infrastructure spending and deficit financing strategy that we saw in the 1970s and the 1980s. Then there's the capitalist dream, which is this notion that really COVID-19, the crisis it caused, will really create that opportunity to strive for greater efficiency. And let's call it the survival of the fittest argument that is out there. And that businesses will use this opportunity to restructure costs, part out of necessity, but part for strategic reasons. They will make greater use of digitization, big data, artificial intelligence, other such processes that will either improve their operational efficiency or help them increase their market access at minimal cost. And you'll see in your sort of primary and secondary industries, you'll see increased use of automation in production processes. And in this way, we will produce either the same or more output at a lower cost. And again, for businesses, there will also be a focus on supply chains, because that is something that this crisis have highlighted. And that focus will really be on how can we secure our supply chains? How can we not ensure that we are not too reliant on one particular source? And at the same time, of course, we will also see that new technologies will be used to develop markets and new geographies to diversify risk. So this survival of the fittest sort of strategy going forward is also still out there. It's less spoken of, but it's also out there. And then there is the pragmatic path. And I think that's where most South Africans fall. We realize we sit with an enormous challenge. We realize it's going to take a little bit of give and take. We will have to fix what is broken, and we'll have to strengthen what works. And I think President Ramaphosa have been pushing for this, for a new social compact. Business have been pushing for this. Most South Africans want to see greater cooperation between government, between business, between labor, between society at large. And we all know that really you can only make progress in the face of the sort of adversity that we face. It's a lot easier if you're united than if you're divided. So the notion here is that we work together to build a better South Africa. Business exploit the opportunities that come their way. They transform their labor force. They transform their ownership structures. It might cost something in the short term, but in the long term, it creates a far more efficient, far more productive, far more motivated, far more equitable society. And they create jobs, and they partner with small businesses. Government commits to restore fiscal discipline, eliminate corruption and efficiency, and to create a more business-friendly environment. And that's largely what you see. It's really the work that's been going on at Business Leadership South Africa, Business for South Africa, within BASA that Mike referred to. It's an enormously long document which really details the ambition, the hope that business can take certain initiatives and the government can respond in equal measure by creating the sort of environment in which those initiatives are likely to be successful, likely to create jobs, and likely to slowly move South Africa forward. And this is the sort of picture that I think everybody would like to see in South Africa. This is the sort of business cycle we would like to see. We are going to take a hit. We will probably have a little bit of a statistical bounce next year. From there, we probably lose a little bit of momentum because we're now coming off a higher base. But the hope is that over time, surely, slowly, and gradually, we will climb onto a higher growth path. So those are the sort of visions of COVID, of a post-COVID world, and of a post-COVID South Africa that is out there. But I think that they all have some elements in common, and they all have a hold of an element of the truth. And it's really just the pragmatic route, the working together, that will make it work or make it fail. And as an economist, I am no better judge as to whether that kind of unity can be fostered, whether these sorts of initiatives can be brought off the ground, than you are. But I can highlight that there are certain essential things that we do have to address if any of these visions of a better South Africa is likely to emerge. The first reality we have to acknowledge is that government cannot drive this economy forward. This is the hippo's jaws that Minister Mboweni represented to us during the supplementary budget. It shows you how government expenditure has exploded, and as government's expenditure has exploded, as the state has grown, it hasn't in fact lifted overall economic growth. It hasn't improved income per capita for South Africans. In fact, it deteriorated throughout that period. And so that increase in government spending has not been efficient at all. It has not been growth enhancing at all. And all it's done really, it's crowded out the private sector, and the outcome of that is that red line, government revenue, has come under increasing strain and has really stagnated. And COVID-19 will place even greater pressure on government's revenue going forward, and greater pressure for government to support the most vulnerable out there. So we are in a very, very really dangerous place fiscally. We mustn't we mustn't deny this. That's not going to help us. And we must also acknowledge that we didn't get here overnight. There were very many signs along the road that we were on the wrong path. Those were largely ignored. Good advice from the IMF, from the World Bank, from investors, from business, from NGOs, from academics. It was all dismissed as fear-mongering. And yet this is where we are now, at a situation where in all likelihood, we're going to shrink by something between 6 to 10% this year, and that we face a very mild recovery going forward. And one of the biggest challenges we've got is the fiscal one. And this is going to make any post-COVID South Africa, any dreams of a post-COVID South Africa, so much harder to achieve. And this is the debt slide coming straight from the supplementary budget, and where Minister Mboweni illustrates what will happen if we do nothing. Debt will just eventually explode until we become very much an Argentina. And we just cannot grow out of that sort of burden. So the suggestion made is, of course, the green line, that we follow this trajectory, but the budget makes it very clear that to get there, it's going to be painful. We're going to have to cut government spending, eliminate waste, eliminate corruption, raise taxes. We're probably going to have higher taxes going forward. And very importantly, government has to reform SOEs. It has to remove the dependence of SOEs on tax and public funds. And you have to implement something that will make us grow faster, create more jobs, create more taxpayers, and therefore help to redress that deficit and bring this debt burden down. The truth of the matter is, while government might buoy this economy this year because government spending will increase, going forward, it's going to be constraint on growth. Government can't drive economic growth going forward. The other hard truth that we'll have to find a solution to is our energy crisis. You cannot grow without electricity. We are unique in this way because we have in fact been building for well over a decade on two enormous new coal-fired power plants. And yet our electricity production and our electricity capacity has deteriorated dramatically. And it is now lower than it was in 2004. So this is a problem we have to resolve. And again, as we sit in COVID-19 and an economy that is barely growing, we are dealing with stage 2 load shedding, not stage 1, not the odd little glitch, stage 2 load shedding. So if we want to have any shot at growing forward, then we have to deal with the electricity issue. The other thing, and lastly, a key point I would try to make is that ultimately we have to create jobs for the labor force we have, which is an abundance of low and semi-skilled workers. And in order to do that, we have to reverse this long-term slide in fixed investment. And one of the big myths we have out there at the moment is that it's the private sector that is on an investment strike, where in fact it isn't. No private sector company would willingly go on an investment strike. Private companies want to exploit opportunities. They want to grow. That's the mere purpose of their existence. And really, the numbers confirm this. The private sector, which is that grey line there, it's done the best it can in a shrinking economy. It's actually maintained capital expenditure. It is the implosion we've seen in the public sector that's been the problem. And I'm now actually just going to skip through to the end and just highlight a few positives and negatives. So we have to create jobs. We have to, in order to do that, reverse the implosion in fixed investment activity. And it clearly is in infrastructure spending. There the ANC and government is completely correct. We have inadequate infrastructure. We have unreliable and expensive electricity. Those are the problems that need to be solved. And unfortunately, government don't have the funding to do it. So the solutions here will have to be what Business South Africa suggests. And that is that you crowd in the private sector. You look for win-win solutions. You establish greater partnerships to get to that infrastructure you eventually need. And some of the positives we have is that we do have a strong financial sector. We do have a sound financial regulation in place, well-regulated markets. We do have prudent and strong monetary policy. And business and government is talking again, and that's a positive. And there is a plan that's been released. It is workable, and it tries to put in place a sound balance between conflicting interests. But what we ultimately will have to do is deal with these negatives. And that is that we ultimately will probably see that things in the very short term will get a little bit worse before it gets better. Fixed investment will probably fall further before it starts to climb higher. There will be substantial job losses. And for us to deal with this crisis, it is also now important that we start to implement, and that government actually starts to show some tangible progress in implementing structural reforms. And National Treasury has said that much. Government has said that much. Minister Mboweni has said we need to re-establish fiscal credibility. So in many ways, it's going to take actions from both sides. It can't be one or the other. And it isn't going to be an easy path, which is why we think in the interim, our business cycle is probably going to look a little bit more like this. This is probably going to be the post-COVID South Africa for the next 3 years or so. We will have a bounce. We know that because of the statistical noise. But we will probably settle at a lower level because this crisis will hurt jobs. It may even destroy some jobs. You will see a push to greater efficiency, greater use of digitization and technology to move us forward. And you will see tremendous adjustment in the process. But ultimately, if we start doing the right things, if we get the basics in place, and if we work together, maybe post-2024, we can start to lift this curve upwards. So really, for me, we have to be realistic. And these are the sort of numbers we've got. We are in a miserable place at the moment. So 2020 is going to be difficult, but it will pass. And we will return to the sort of growth rates we had before. It's not good enough. That's the point, though. And what we are very hopeful of is that hopefully there will now be the recognition that government cannot spend their way out of this crisis. So the only way that we can actually get through this is by working together and by involving the private sector. And if we do that, I do think South Africa could move to much higher growth rates. Thanks. That's all there is from me. I know we're probably out of time. But if there are any questions, I'll return to Don now, and we'll take a few maybe if you've got time. Stay with us. And otherwise, please feel free to just send them, put them there, and I will answer them. I promise you, I will send it through to you, and they will attach it to the recording of the session.
Thanks, Nikki. Nikki, there are quite a few questions, but I think just in the interest of time, we'll just address two of them. One of the questions was, to what extent will there be international support for the recovery of the South African economy? If you want to just answer that.
Okay, so again, it comes down to, we have to some extent be realistic. We have wasted a lot of goodwill over the last decade. As I said, the writing was on the wall. Many people warned us, and yet we ignored all of that. Our fiscal position has deteriorated. There is inherently more risk attached to operating in South Africa. So I think, quite frankly, global investors are skeptical of South Africa, and what they would like to see is implement some of these structural reforms you have spoken about in your budgets year in, year out, for the last decade. So I think it's up to us, and it's especially up to government. The onus is on them to now start to actually stop designing plans and just start to implement the basics.
Great. And then just one final question, which I'm sure is on everybody's lips, but your views on the Rand 1 year out, and I suppose that's dictated to where interest rates are as well.
Again, a lot of people obviously, there is this view that the dollar will weaken. That is the explicit purpose of the Fed's interactions. They want to keep the US economy competitive. They don't really want to see a strong dollar. And so, this aggressive liquidity injections we've seen means that there are more dollars in circulation. Up till now, they've all been grabbed up by the world economy. Okay, so essentially that's been the reality. It's almost like the Fed can't keep up with the demand for dollars out there. But over the last 3 weeks, we have seen the dollar recede, and the pattern is becoming a little bit more predictable. So I do think the dollar in the short term will be under some pressure. That will help every other currency against the dollar. Secondly, South Africa does offer a very high yield to investors, among the highest in the emerging market universe. But we also come with much more risk than we did during the global financial crisis even. And so as a result, it is a tricky situation and it's very difficult for me as an economist even to say, will investors take the bait? Will we see a revival of the carry trade? If we see a revival of the carry trade, the Rand will strengthen, it will pull back. So what I think will happen in this case is that the Rand will pull back. You'll probably see at some point later this year and early next year that the Rand will settle below 17 to the US dollar. But I don't think it's going to be the sort of convincing recovery that we saw immediately after the global financial crisis and passed and after the worst was over there. The reason simply being that there's more risk attached to South Africa, and we will have to take the first steps to restore our credibility.
Great. Well, thank you, Nikki. That was most informative. And I don't think Mike is still on the line, but obviously thanks to Mike as well. And that really concludes our investment webinar, ladies and gentlemen. And I do think as we are living in a period which is characterized by increasing uncertainty and it is exceptionally fluid, I think it's important that we try and get a clearer picture of what lies ahead and get a better understanding of what really is happening behind the scenes. This can only help us both. It can help us to make more informed investment decisions that ultimately will grow and protect your capital. So thanks everyone, and stay safe.